You're probably wondering how you compare to the average person when it comes to money. Are you ahead or behind in regard to your finances? How do your earnings and spending compare to others? Some of these financial statistics of the average person are absolutely going to surprise you. In fact, these numbers are probably going to be pretty eye-opening. I help teach people about money, personal finance, and investing. If you want to become financially free and not have to worry about money, make sure to subscribe to the channel and like the video if you find it helpful. Housing equates to about 34% of spending for the average household, according to the U.S. Department of Labor statistics, making it the largest expense for just about every budget. This equates to about $1,900 per month in the current market. Renters are faced with rent increases and difficulty finding homes to rent, while homeowners are faced with rising home prices, skyrocketing interest rates, and other increasing costs such as insurance, taxes, utilities, and maintenance. These factors make both renting and buying less affordable. Spending too much in this one area can be detrimental to your budget, making it hard to pay for other expenses. If a huge chunk of your income is immediately spent on keeping a roof over your head, it doesn't leave much left over for transportation-related costs, food, and other necessities. It's nearly impossible to get ahead if this one expense is consuming a large portion of your income. Bankrate says the average payment for a new car is $700 per month, and the average payment for a used car is $525 per month. These amounts might sound ridiculous, and that's because they are for most budgets. But thankfully, most families aren't spending this much on a car payment alone. Value Penguin says that the average family spends a total of $819 per month on transportation, which is the second largest spending category just behind housing. Total monthly spending of over $800 per family isn't that out of reach, considering this includes all transportation-related expenses such as gas, insurance, maintenance, car purchases, and so on. Unfortunately, many people are tempted by the thought of a brand new car, and they see it as a way to reward themselves. While it might make sense for some people, let's not forget that it's still going to spend most of its time parked in your driveway. The average age for first-time homebuyers has reached an all-time high of 36 years, according to the National Association of Realtors. This marks a significant increase from 33 years old just a year prior. One of the primary reasons for this trend is the limited inventory in the housing market, which has pushed prices higher over the past few years. This scarcity, combined with rising home prices, has made it increasingly difficult for first-time buyers to enter the market. Even with loan programs available to help buyers purchase a home with 5% down or less, the overall costs are still substantial. In addition to the high purchase prices, homeownership comes with various additional costs. Taxes, insurance, utilities, and maintenance can easily match or even exceed the monthly mortgage payment. These extra expenses inflate the overall cost of owning a home, making it a challenging financial commitment for many. The rising costs and the increasing average age of first-time homebuyers reflect the growing financial barriers to achieving home ownership. The burden of student loan debt is another significant financial challenge for many individuals. The average federal student loan debt stands at approximately $38,000 per borrower, while private student loan debt averages around $55,000 per borrower. These figures show that the average student loan debt has tripled since 2007, according to educationdata.org. For new graduates, this debt can be crippling, especially when entering a career field with no experience and limited entry-level salaries. Many graduates face a misalignment between their debt and their salaries due to poor return on investment on their chosen majors. Without proper research and planning, students may find themselves obligated to repay substantial loans with salaries that do not correspond to the level of education obtained. This financial strain can delay other life milestones, such as buying a home or saving for retirement, as they struggle to manage their loan repayments on limited incomes. The average person in the United States pays $1,233 every month towards debt payments, according to LendingTree. This total includes car payments, personal loans, credit cards, student loans, and mortgage payments for homeowners. For those whose mortgage is included in this amount, it might not seem too bad. However, for many others, managing these payments is a significant financial burden. High debt payments can severely hinder an individual's ability to save for the future and achieve financial stability. Not only do these payments consume a large portion of their monthly income, but they also involve paying substantial amounts of interest to banks and credit card companies. This debt trap makes it difficult to save for future expenses, meaning individuals may be forced to borrow even more money when unexpected costs arise. The cycle of debt and high monthly payments creates a financial strain that can be challenging to break free from, impacting long-term financial health and stability. On average, Americans spend about $1,500 per month on non-essential items. This category includes dining out, subscriptions, impulse purchases, and other discretionary expenses. It's astonishing how quickly these seemingly minor expenditures can add up to a significant amount. Many individuals find themselves struggling financially but often blame external factors for their difficulties, rather than examining their own spending habits. While it's important to enjoy life and reward yourself, prioritizing your spending is crucial. Before splurging on non-essentials, ensure that your financial basics, such as debt repayment and savings, are in order. Properly managing these expenditures can free up more resources for savings and investments, helping you achieve a more stable financial future. When it comes to retirement savings, the figures are somewhat disheartening. The median amount saved for retirement for individuals aged 55, 64 is $134,000, and for those aged 65, 74, it's $164,000. Unfortunately, these amounts are often insufficient to cover living expenses throughout retirement. A $200,000 nest egg, for instance, would only produce about $8,000 per year if using a 4% safe withdrawal rate. Given that the average Social Security benefit is around $1,550 per month, many retirees will need to continue working part-time to make ends meet. The gap between what people have saved and what they need to comfortably retire highlights the importance of planning and saving early. Median income varies significantly by age group. For instance, individuals aged 45, 54, have a median income of about $61,000 per year. However, this income level doesn't necessarily translate to financial comfort due to regional differences. The cost of living and taxes in different areas can drastically affect how far that income goes. In high-cost areas, $50,000 or $60,000 may not provide much financial leeway, whereas in areas with a lower cost of living, the same amount can offer a more comfortable lifestyle. Additionally, household dynamics play a role. Those who share expenses with roommates or spouses often find it easier to manage their finances compared to those who bear the full cost of living on their own. Understanding these average financial situations can be eye-opening and reveal areas where you might need improvement. By acknowledging the common financial pitfalls and taking steps to address them, you can position yourself to be well above average. It's not about living in a constant state of struggle, but rather about using discipline and forward thinking to build a better financial future. If you found this information helpful, make sure to subscribe to the channel and like the video for more tips and strategies on achieving financial success.